Good morning. Good afternoon.
Good. I'm Mike Thompson. I'm with Envoy Mortgage. We have Jerome here with Leo Mortgage, and we're going to just go over really the fundamentals of getting approved for a mortgage, and we'll get things underway.
Welcome, everyone. So thank you for being here. Let me start by saying it would be impossible to cover everything that you need to know about mortgages in the time frame allotted here. So this is really more just a framework of the industry and what to expect when going for a mortgage. So if you hear something different when you leave here, it doesn't mean that we were wrong and they're right, or that they're right and we're wrong. I'd like to believe it falls under the fact that there's just more information than we could possibly cover in one sitting with regards to mortgages. So that's my little qualifier, I'll put it out there. But as Mike said, I'm Jerome Scarpello, I'm with Leo Mortgage. It's actually good that we have two different lending sources here today, because you'll get a perspective on the different types of financing sources available to you today. And there's really up to your own situation as far as what's the best mortgage for you. So without further ado, I'll get started. And my first slide worked, so that's a good start. So today what we're hoping to really accomplish is that you guys can answer a few questions when this is all done. Is getting a mortgage or really owning a home right for you? Because although we're both advocates of buying a home or owning a home, for some people, renting makes more sense. And so we're going to cover that quickly. We'll also talk about how do I qualify for a mortgage? What are the things that lenders look for from you in order to qualify? And spoiler alert here, we're going to give you the secret recipe that lenders use so that you guys can do it yourself and at home crunch numbers and at least get an idea of, based on your income, your assets, what a lender would say you would qualify to pay. And then go into the different types of mortgages. For simplicity purposes, we've simplified that to simply conventional loans, FHA loans, and VA loans. And we'll go over those when we get to that slide. And then lastly, probably the biggest impediment to people buying a home is the amount of cash that you need, and how much does buying a home cost, and what are some of the strategies that you can use to, compress that. Anything to add, Mike?
No.
Okay.
No, the other thing I'd mention is a normal emotion you have right now is you're excited and scared all at the same time. I don't know if anybody can relate to that. That's normal. And what we do as lenders is trying to ease those concerns, and that's what we're good at. So don't be alarmed if you have those feelings running through your veins at the same time.
Okay, next slide. So is getting a mortgage right for you, or is really buying a home right for you? So I won't waste a whole lot of time, but there really are considerations that you have to take on. Buying a home is a serious thing, and owning a property requires certain responsibilities that you don't maybe have when you're renting. If the toilet leaks, you call the landlord and they send a maintenance person out. When you're renting, if you own a home, that's not the case. As you know, you have to take care of those repairs yourself. So it's important to set money aside for unexpected repairs, and that's one of the responsibilities. There's also the limitations on being able to be mobile. So if you're in a situation where your job may take you from place to place or city to city or state to state, for somebody that rents an apartment, it's simply terminating that lease. For somebody owning a home, there's more consideration. You have cost to sell, cost to buy, and again, we'll cover some of that today. But one of the things that I think makes owning a home really the best choice in the majority of cases is the tax deductibility of the interest, or the tax advantage of owning a home versus renting. And this isn't a seminar on tax deduction or tax interest, but when you factor in the tax deductibility of the interest on your mortgage, your overall cost is actually less than what you might think. So even though your mortgage payment may be higher than what you currently pay in rent, overall you might have a greater benefit by renting or by owning versus renting. Okay, so how do I qualify for a mortgage? The lender's going to cover different aspects, so maybe Mike, you want to?
Sure, absolutely. The things that we look at is employment and income. We're going to take a look at assets. We're going to take a look at credit. And it's really the combination of those three things that determine how much we can approve you for and whether or not we can approve you at all.
And so, the things such as how long have you been employed, how much do you have in assets, and yes.
You said assets, you consider just national assets or can be international? I mean, if I have a condo in another country, you consider that?
That's a unique situation that it's going to be a case-by-case basis, but that can be considered. Yes.
Employment. I'm a home health aide, and I prefer agency work. I have, like right now, I have 2 jobs. So if you had one stable job from one time to another, but you constantly like a second job, would that hurt you with the stability of your job?
So to be able to use 2 income sources from 2 jobs, they look at no breaks for that second job within the last 2 years. So if you took a month off from the second job, then you wouldn't be able to count that income. But for the most part, if you've been working 2 jobs and we can document that for 2 years, and there's ways that we do that, then that's considered stable income from both jobs. So we could use that. Yeah, and what we're going to do is we're going to handle questions at the end just because we are in a little bit of tight timeline because we're back to back with seminars. So the other thing I'll talk about is if you're an hourly employee or salaried, hourly, what's going to happen is we're going to order what's called a verification of employment. We're going to match that up with your pay stubs, and it's going to show how many hours on average you work in a given month, and we're going to use that to help calculate income. If you're commissioned or self-employed, we're really going to take a look at the past 2 years of your income. If you're self-employed and you've seen a decline in income, we want to talk about that sooner than later. There are some programs that we can work around that, but for commissioned or self-employed people, it's normally a 2-year average. And the final thing that we're going to talk about here is qualifying ratios. It's a term called debt to income, and it's a math calculation. And we're going to talk about some ratios of 33 and 43%. And I think that's maybe what we have next.
Exactly, and I'm just going to take this moment, if this will erase my name and Mike's name, and I'm going to give you that secret recipe that I promised you real quick. And again, I qualify this by saying there's many more factors affecting it, but essentially, I do these sorts of presentations a lot, and I've really tried to simplify it, that how can somebody take from this presentation something that they can go home with. So, and by the way, if you don't get all this, that's okay. More important is that you understand there's information available to you and there are resources available to you. Mike's very good at helping. I'm very good at helping. The room there is filled with other lenders that can certainly help you, but any search begins online. The problem with that is you can't have an interaction. So I say a lot, whether it's me or Mike or somebody else, you really should probably sit down with someone to discuss your situation. What's your income, what's your assets, what's your credit, and then based on that, we can better guide you. So if what I'm about to go through goes over your head, please don't get overwhelmed. Understand that somebody can sit down and talk to you. So I'm going to break it down this way. A, B, C, and D, real quick. Number one, they're going to take your monthly income and they're going to multiply it by 33%. Let's say that equals A. Then they're going to take your monthly income and they're going to multiply it by 43%. And let's say that's B. Then they're going to take your monthly debt, and again, we're going to discuss what is considered debt in the lender's world. And they're going to take the monthly debt and they're going to subtract that from B. And then you're going to take the lower of A or C. Isn't that simple? I'm laughing because I can imagine it probably went over some people's heads, but that's the secret recipe. I talk about, what lenders use to determine how much you qualify for. In simple, very simple terms, they look at what you earn monthly, they multiply it by 33%, and they set that aside. Then they take a look at what you earn monthly, they multiply it by 43%, and they subtract what you're paying in debt. What's debt? Your car loan, your personal loan, your student loan, your minimum payments on credit cards, if you pay alimony or child support. So what strategies can you use to maybe improve the situation if it's not giving you enough to qualify? And that's some of the things that Mike and I are going to talk about. So in this next slide, I'm saying do the math. So you can take this formula and bring it home and do your own math. But essentially, let's say Susie earns $54,000 a year and pays $600 a month in a car and credit card debt. How much does she qualify for? Well, they take her income, they divide it by 12, they get her monthly income. You multiply that by 43% and subtract her debt, and she qualifies for $1,335. Again, if that went over your head, don't worry about it. Somebody will help you, whether it's me, whether it's Mike, whether it's your own bank or credit union. But this is the way it's looked at. So what I illustrate in the slide here is that under note, if Susie didn't have any other debt, she would qualify for more. So very simply put, because of Susie's situation with her $600 a month in debt, she qualifies to pay $1,335 pity. You guys may have heard the term pity in searches for homes. I always say it's a pity you have to make your mortgage payment, but you do. But pity is the acronym used in the lending industry to cover principal, interest, taxes, and insurance. So when you talk to somebody like Mike or me, and we say you qualify for $1,335 pity, that means your total housing expense, including your taxes and insurance. What I'm trying to illustrate with this note is that had Susie not had that other debt, she would qualify for $150 more a month. That $150 more a month is about $30,000 in the mortgage. So without filling you with too much gobbledygook, at $1,335, assuming taxes and insurance are $400, that's about a $200,000 loan. At $1,485, it's about a $230,000 loan. I feel like I'm repeating myself, but if that went over your head, don't worry about it. Talk to somebody who will plug your numbers into the formula and spell it out for you. But this is the math. This is the way the lenders use it. Again, principal, interest, taxes, and insurance is what's made up of pity. If you're buying a home that has an association fee, for example, a condominium or a townhouse, that also has to be calculated in. Anything you want to add, Mike?
No, the one thing I'll point out is twofold. One, taxes are property taxes, and depending on the school district that you're looking at, that can make a huge difference in terms of how much house you can afford. Different areas have different property taxes, and that's something you want to talk to your lender about and also your realtor about. The other way when we talk about insurances is just not property insurance, but it also could be mortgage insurance. If you're not putting 20% down, then you're going to be looking at mortgage insurance, which we're going to talk about in another slide. But there are different loan programs that have different mortgage insurances, and we'll talk about that, but that also can make a difference in terms of how much house you can afford.
The other consideration lenders look at, we talked about it a little bit earlier, are your assets. So it costs money to buy something. And it's no different when you buy a house. It costs you money. Yes, you'll get a mortgage for a portion of the sale price, but the balance between the mortgage and the final sale price is money that you're going to come up with insofar as down payment. Now, when you use money to buy something, it's rare that the person you're buying it from cares where the money came from. That's not the same in the mortgage world. When you buy a home, the lender wants to know, where did this money come from? Why? Because they want to know that you didn't borrow that money to borrow this money. Because if you did, it could potentially affect how much you qualify for. So the lender's going to trace your funds. You might want to speak to that a little?
Yeah, it's a 60-day look-back period. So, I would take a look at your deposits for the last 60 days, and if there's large deposits that aren't work-related or we can't source, that's something your lender is going to want to know about. There's some potential workarounds there, but the sooner your lender understands and takes a look at your assets, it's going to make a big, big difference. And assets are a combination of everything from your checking, your savings account, your retirement account. Do you notice the one thing I didn't mention there? And that's cash. Lenders do not like cash. We do not like mattress money. So if you're in a situation where all of your money is mattress money, that's something you need to let your lender know sooner than later, because that could slow down how quickly we could get you into a house.
And then a lot of times I'll look at somebody's bank statement because that's part of the process of approving somebody's mortgage, and you'll see deposits going in, and I'll say, oh, where did this $2,500 come from? And they'll say, oh, my father gave it to me because he knew we were buying a house. That's okay. We call that a gift. So that would need to be documented. Very simply, your father signs a letter that says, I swear to God, I gave him $2,500. And you show us your bank statement showing the $2,500 going in. Well, that's what brought it up. But they're also going to see Dad's bank statement showing the $2,500 coming out. So, a word to the wise, as my old teachers used to say. If something like that is going to happen in your life, you're going to be getting monies from mom or dad or brother or sister, perfectly okay. Think about me before you take the money, because they're going to want to see the money coming out of their account and going into your account. Make a copy of the check before you deposit it. Let your lender know what you're doing. One last note on assets. When determining your ability to get a mortgage, or yes or no, do they get the mortgage, they want to see, obviously, that you have stable employment, we talked about. They're going to calculate your ratios, as we talked about. They're going to look at your assets. Some mortgage programs require that not only you have enough money for closing, but you have over enough money for closing. They want to see that you're not spending your last nickel to get into your home. That's called reserves. Reserves are funds that the lender likes to see in the bank over and above what you need for closing. Doesn't have to be in the form of checking or savings. Reserve assets could be money that you have in your 401k plan or an IRA, something of that nature. But some mutual funds is perfectly acceptable, but some mortgage programs require that you have reserves, and that's what I mean in this slide. Okay, the next topic, and this we could take a whole day on, is credit. So maybe Mike, you want to start?
Sure. You know, when somebody extends you credit, obviously paying it back is one part of it, paying it on time is another part of that. But when it really, what all that leads up to is what your credit score is going to be. Depending on the lender, you could get into a mortgage with a 580 FICO or higher, depending on the loan program and depending on with the lender. But they're going to take a look at your credit scores and understand that a credit score, it's a snapshot in time. And what your credit score looks at this month could be different next month, depending on what your balances are and your limits are on those particular accounts. Or if you've had a late payment this month, then guess what? Your credit score is going to drop like a rock because you had that late payment. So I think there was already a seminar today talking about credit. And if you have any questions about credit, Genesis Housing has a booth up in the front of the room. They're phenomenal credit. They have free or next to free workshops. They'll sit down with you one-on-one and talk about credit. If you do not have credit, there's ways to establish credit in a relatively short period of time. However, lenders like to look for at least 3 trade lines over the past 2 years. And they like to see that much of a history because that's really what's going to give it a good, accurate representation of what your credit score is. So again, they're looking for 3 trade lines over the last 2 years. And the other thing I'll mention about credit scores is most lenders go off of the FICO scoring model. And you're going to see some credit card or credit companies out there like Credit Karma and freecreditreport.com, where if it's a free service to allow you to pull your credit, but sometimes they go off of a different scoring model, so it's not a real accurate representation of what a lender's credit score would be. So again, if you're looking to buy a house, the earlier you can have a lender take a look at your credit, I think the better off you're going to be. The other thing is fixing bad credit. Most lenders have an opportunity where if you had a hiccup in the past, we can do what's called a rapid rescore and get something removed relatively quick. If it's a bigger issue, then again, we may position you with Genesis Housing where they can work with you over a period of time to repair your credit.
Okay, so what are the different kinds of mortgages? There's so many programs out there. I talked to quite a few of you. I recognize some of you from my booth, and thank you for coming up. And I heard one young lady say to me, you know, it's overwhelming, and it really is. I mean, there's a lot of information out there, and, you know, as I sort of said at the beginning, what I really hope you take from this more than anything is that there are resources out there, that there are people out there that can guide you. And I snicker a little bit when I think about the internet because, you know, the internet's got so much information, but you really need a back and forth discussion. And yes, you might have live chats, and I understand that sort of thing. But the point I'm trying to make is, you know, whether it's Mike, whether it's me, whether it's your own bank or credit union, whether it's any of the fine lenders out in the room, you really want to sit down with somebody and, you know, discuss your own situation. So to really simplify this presentation, I've broken it down as essentially 3 different types of mortgages. Okay, there are conventional loans, there are FHA loans, and there are VA loans. Anybody in the room a veteran by any chance? Thank you for your service. So the VA is the Veterans Administration. Great program. Allows 100% financing. It's backed or insured to the lender by the federal government. The FHA is the Federal Housing Administration. Like VA, it carries a government insurance. An insurance not to you, but to the lender, that if you don't make your mortgage payment, the lender gets repaid. So lenders like insurance like that because it puts them in a good position. So when I say a conventional loan, I simply mean a loan that does not carry the government's insurance. Okay?
And you're also going to find that your interest rates are going to be a little bit better on the government loans because of that insurance. Banks, you know, they hedge risk, and they're going to give you a higher interest rate if it's a riskier loan. Conventional loans on the lender side of things are a little bit riskier, so you're always going to get a little bit better rate with the government loans, such as FHA or VA.
So the slide that's up there now gives sort of a compare and contrast of the different types of loans. So we just went across the top, conventional, FHA, and VA, and down the side, the minimum down payment, insurance, ratios, and seller assist. So, Mike, do you want to start with that?
Sure. So with a conventional loan, minimum 3% down, and there's different variations of that after that. FHA is going to require you to put 3.5% down, and a VA loan, no money down. So understand when you're buying a house, it's a combination of 2 things. One, your down payment money, which is this calculation, and then closing costs, which we're going to talk about a little bit later. Now, if you notice, on these options, you're not putting 20% down. So since you're not putting 20% down, you're going to have mortgage insurance. And it's called a couple different things depending on what type of loan you have. With a conventional loan, it's called private mortgage insurance, and it's going to vary depending on how much money you're putting down and also what your credit score is. With the FHA loan, you're going to pay mortgage insurance 2 ways. You're going to pay 1.75% up front, but it's going to be financed. So it is a cost, and it's something that gets paid to FHA, but they allow you to finance that. But what's going to happen is they're going to take 0.85% of your loan amount, divide that by 12, and that's going to be your monthly mortgage insurance. And the challenge with FHA is right now that mortgage insurance never goes away. So there are some instances where long-term, maybe a conventional loan is a less expensive option because the mortgage insurance will eventually drop off in a conventional loan once you build about 20% equity in the house. On a VA loan, there is the upfront funding fee depending on whether or not you've used your entitlement before, but there is no monthly mortgage insurance. So for the veteran in the room, you're in a phenomenal spot to pursue a VA loan. You want to touch on the last thing?
Sure. And then we talked about it briefly, and this is the math, and I say don't let it get over your head or don't get overwhelmed here. You know, this is the way a lender looks at you from a qualifying standpoint. Ideally, you're not spending more than 33% of your monthly income on PITI. Everybody remembers what PITI is, right? Mm-hmm. Principal, interest, tax, insurance. Then, ideally, your mortgage payment plus your car loan, minimum payment on your credit card, your alimony or child support, whatever it is you pay. Student loans. Doesn't exceed 43% of your monthly income. I won't bore you with the math, but it's the same math for FHA and for VA. Interestingly, VA really has no front ratio. They really just want to see that your total debt service ideally doesn't exceed 41%. Then lastly, and we'll talk about this in an upcoming slide, you know, the cost of buying a home, and one of the ways to compress the costs is to get what's called a seller assist. What does that mean? Well, let's say you see a house you like and you think, oh, this is perfect. They're asking $100,000. It's got the big yard fenced in so I can put the dogs back there. Everything's going to be great. But you know what? I'm not going to give them more than $95,000. in some cases, you may be better off saying, I'll give you $98,000 if you pay $3,000 of my closing costs. Now, why would you do that? Well, whether you pay $98,000 or $95,000, it's not going to significantly change your mortgage payment. In fact, each thousand is less than $5 a month. But by negotiating with the seller to pay $3,000 towards your closing costs, you've just compressed the amount of money you need by that $3,000. Well, the mortgage companies have something to say about that. The maximum seller assistance that you can get on a home, if you put less than 10% down, is 3% of the sale price. All these rules and regulations, I feel like a broken record. Don't get overwhelmed. If you don't remember this, that's okay, we do. Talk to somebody. FHA will allow up to 6% seller credit. And VA, there's certain qualifiers on that, but I put 4%, Mike, for the purpose of the discussion. So, what does that mean? Well, if you're in a situation where you're cash challenged, you don't have a whole lot of cash, FHA may enable you to get a greater assistance from the seller in order to compress the amount of money that you need. Now again, why would a seller agree to pay part of your closing costs? The answer is they want to sell like you want to buy. So in my example, if you say, I'll give you $98,000 if you get $3,000 towards my closing costs, they may respond to you by saying, no way. If you want me to pay $3,000 of your closing costs, the price is $101, and that's negotiating. And that's where you talk to a real estate agent or somebody in the industry to come to some meeting of the minds.
And I wouldn't be shy about asking for seller's assist. Probably 60 to 70% of the transactions I do have some type of seller's assist on them. And Jerome, I have one question.
Sure.
Going back to ratios and income, is that off my take-home pay or is that off of my gross income?
Oh, great question. That's off your gross income. Great question. So if you earn, like Susie does in our example, $54,000 a year, and you divide that by 12, that's $4,500 a month. Susie's not bringing home $4,500 a month because you got federal, state, local taxes. I'll never forget, my son got his first job. He's like, who's FICA? Who said they could take money out of my check? So that's the net income, right? But the gross is what the lender's going to use to qualify. Yes?
Is it the same formula if you're married?
As far as qualifying,
Yeah, so the ABC.
it is.
Just double whatever yours is.
It would be the total household income, right? So if you're married, the person you're married to's income would get added to your income, and then you would do the math and run it through the formula. Okay, I told you there's probably more mortgage programs than we could possibly cover in this presentation. We tried to just give you the highlights of the three basic types, but I don't think it would be complete if we didn't mention some really spectacular other programs available. One of them is through the United States Department of Agriculture, the USDA. They have a rural housing program. Mike, you want to touch on that?
Awesome loan program. There's two big limitations. A, you can actually overqualify for it, and you can make too much money, as crazy as that sounds. Montgomery County, as long as your income, household income is pretty much below $92,000, you should be fine. But there's also a geographical limitation, meaning you have to buy in an area that is USDA eligible. So around here, if you go north of here, above 40-foot road and up above like Harleysville, that's all USDA eligible. If you go out the 422 corridor, really everything beyond, let's say, Audubon and along 422 is all USDA eligible. Here's the places that aren't going to be eligible. It's based on population count. So if your population count's really above 15,000 people, your Phoenixvilles, your Reddings, your Pottstown, those are the areas that you're not going to be a USDA eligible. Great loan program. It's one of the trickier loans in the underwriting side of things, but again, if you can get a USDA loan, it's a great option for you.
And then another program we want to talk about is through the Pennsylvania Housing Finance Agency, the PHFA. We have, as a matter of fact, one of our esteemed guests is from PHFA. Barbara, don't be shy, say hello to the crowd.
Hi.
Yeah, that's Barbara. She's with PHFA. So she knows everything there is to know about PHFA. Don't answer that. But Barbara has a booth out there with great information. But PHFA, I can tell you, is one of the best loan programs in the Commonwealth of Pennsylvania. And it is limited to PA. Oh, that's my timer. We're already done our presentation, but I'm going to finish. If somebody can tell me how to shut this off. Okay. PHFA has, again, more programs than we could possibly cover today. But one of them, or a couple of the highlights I want to point out, they have the mortgage credit certificates. So what does that mean? Well, PHFA has a program whereby, for qualified buyers, home buyers can claim up to 50% of the mortgage interest paid in a year, capped at $2,000, off of their federal income tax. So what does that mean? Again, if it goes over your head, you want to sit with your accountant or your H&R Block guy. The ability to deduct the interest on your mortgage is one of the greatest advantages to owning a home versus renting. PHFA has a special program on the mortgage credit certificates. They also offer loans through the HFA preferred risk sharing. HFA is the Housing Finance Agency. They have a self-insured loan program. So we talked about having the need for mortgage insurance if you make less than a 20% down payment. PHFA has a program whereby for a slightly higher interest rate, there is no monthly mortgage insurance. So when you do the math, even though the interest rate is higher, your overall payment's going to be lower because you're spreading that out over the 30-year term. Again, you want to sit down with a mortgage person to get the specifics on that. PHFA also has a home modification program. So if any of you are caring for someone, or if you yourself are someone who has special needs, PHFA has a program whereby they will lend you money not only to buy the home but to also modify it, to fix it, for access, for ramps, handrails. I've seen situations where a blind person had a guide dog that they needed the yard fenced in. So there's special programs available for that as well. Again, I would encourage you to visit Barbara's table. She's got handouts on all these programs that we're talking about. And then lastly, there's the renovation loans. Mike, you want to touch on that?
Sure. Okay. So you're out there looking at houses. You found the absolute perfect house, but you know the kitchen hasn't been touched in 60 years, and it's the one thing that's holding you back from stopping it. Well, there are renovation loans out there that will allow you to buy the house, let's say for $75,000, borrow another $10,000 to redo the kitchen. We're going to lend you the $85,000 to buy the house, put a new kitchen in it, and we're going to finance all that into what's called a renovation loan. There's a couple different variations of it. It's a phenomenal loan program. Right now, there's a lot of bank-owned properties, a lot of foreclosed properties out there. Inventory's tight. So keep this in mind. Renovation loans exist. You may need a little bit more money up front to get into the house because there's some additional expenses there. But we're going to allow you to finance the renovation costs. And that could be everything from a new kitchen, a new bath, if the place needs a new roof, if it needs energy efficient items. There's a lot of different options with renovation loans. And again, it's an underutilized product, but it's a great, great loan product to help you find the perfect house.
And then two others that aren't on the slide I just want to mention. Fannie Mae has come out with the Home Ready loan, which allows up to 97% financing. That means 3% down. But the down payment funds can come from flexible sources. So where some programs require you to have a certain amount of money of your own funds over and above any gift or seller credit, this Home Ready program allows those funds to come from flexible sources. So it doesn't have to be your own funds. They also have a feature whereby they will allow a non-occupying co-borrower's income to be included in the total formula for calculating how much you qualify for. Stay tuned for more information. See your mortgage professional, because there's a lot of strings attached to that. You just want to know that the thing's available. And then lastly, there's I think it's a Freddie Mac First Front Door. Is that a Fannie? Yep. Freddie Mac First Front Door program, whereby they'll lend, is it $5,000 is the cap? They'll give you up to $5,000 in a grant that you can then use for the assistance in again, compressing the amount of money that you need for down payment and closing costs. So again, the basis of the whole presentation is just know that there's information available, and then talk to an individual to get the specifics on your own case. Okay, how much does all this cost? This is sort of a general guideline for you, but unless you're getting a VA loan or USDA loan, typically you're going to need some down payment in the range of 0 to 5% of the price of the home. In addition to the down payment, you're going to have closing costs. And I find that closing costs work out to be somewhere in the neighborhood of 4 to 4.5% of the price of the home. I find the higher the price, the lower that number becomes. So when somebody says to me, off the top of your head, Jerome, how much money should I figure I need to buy this $100,000 home? I tell them 9.5%, or $9,500. And then I usually get an answer like, well, I don't have $9,500. So that's a perfect lead into the next slide, which is what are some of the options that we can use to decrease the amount of money we talked about? Well, I'd already talked about the seller credit. There's also an option for a lender credit. What does that mean? That means, again, in exchange for a slightly higher rate, the lender may agree to pay part of your closing costs. In addition, you can compress the amount of money you need by getting a gift from mom, dad, brother, sister. It really should be a family-like relationship, not resulting from this transaction. You can't get a gift from your mortgage loan originator or your real estate agent or the seller, but you can get a gift from a family member or a close family-like relationship. And then lastly, Mike, you want to touch on some of the grant programs that are available?
You're fortunate. We have Corey from Montgomery County Housing that offers the grant program from Montgomery County. That helps you with up to $10,000 in terms of down payment money and closing cost money. It's a phenomenal program, but there's a couple caveats to that. First off, you got to go through their program and receive their approval letter before you can go under contract to buy a house. And that's something they can take, I would say, probably 3 to 4 weeks, depending on how busy they are. So they have a booth out there. I would highly suggest stopping by there if you're interested in some of the lower down payment options or the grant money.
Can you repeat that name again?
It's Corey Springer, and she has a booth out there. It's the first booth as you come in on the right-hand side.
Thank you.
Sure.
And then our final slide is just a summary of what we've talked about today. You know, just again, reminders, is getting a mortgage right for you? Not for everyone. I mean, for some people, the ability to call the landlord for the leaky toilet and not have to have the responsibilities that are associated with home ownership are right for them. That's something only you can decide. You also have to consider proximity to work and your ability to be mobile and those sorts of things. How do we qualify for a mortgage? Again, we gave you the secret recipe and the formula. If you didn't get that, email us. We'll be happy to send it to you again. But you really should sit down with somebody and get your own situation. Mike?
You know, we talked a little bit about different types of mortgages and what's all this cost. I mean, my biggest takeaway from all this today is you're in a fortunate situation because you have a room full of experts out there and you have some phenomenal lenders. I would highly suggest talk to your different lenders, get a feel for who they are, how they do things, but also try and set up some one-on-one time with them so they can sit down with you one-on-one, learn more about your situation, and coach you and walk you through some of these different programs.
Any questions? Well, thank you all for your attention. I appreciate your attendance.